What's the bottom line dollar value of your portfolio? If you're like most U.S. investors, you assume that the yardstick of your portfolio, the dollar, tells you how much it's worth. And you assume that this yardstick is fixed and never changes. The truth is that the value of your currency is anything but fixed. It changes every day, and when it shrinks, it can give you an entirely false impression. You think your portfolio is growing, when in reality, it may be doing precisely the opposite. Can that happen to American investors? What would you do? Martin Weiss and his team of analysts at Weiss Research have some recommendations. Martin, why are currencies so important to American investors?
Well, David, until now, the only ones who have typically paid attention to currency fluctuations have been sophisticated international investors. They look at their portfolios in their own currencies, but they also look at their portfolios in other major currencies, such as the US dollar or the euro. But most American investors don't care. All they care about is the bottom line in dollars. They could get away with that in the past, but we don't think you'll be able to ignore currencies anymore, and here's why. First of all, the currency market is extremely volatile, especially recently. There are huge gyrations in the value of all major currencies, not just the euro, but also the Japanese yen, the US dollar, and other currencies. The second reason is governments. Their neglect or even deliberate destruction of their own currencies is unprecedented.
But why would they neglect that?
Mainly to ease their own debt burdens. I mean, all major governments are loaded with debts, we know that. And the easiest way for them to pay those debts is to print money, debase their currencies, and pay back with cheaper paper. You know, no matter how much leaders in Washington, London, or Tokyo say they want to defend their currencies, the fact is that behind the scenes, most of them want to debase their currencies to help pay off their debts and also to help slash their export prices.
So is the U.S. dollar in danger of the same devaluation we've seen in the euro going through recently?
Yes, and in fact, the dollar could be the next major victim. As we showed you last week, virtually all of the sins that have been committed in Europe have also been committed in the United States. Huge debts and deficits, weak banks and massive speculation with derivatives. And those problems ultimately make the US dollar vulnerable to the same kind of currency collapses that has hit the euro. And here's the fourth reason you should be aware of currencies. As Weiss analyst Larry Adelson tells us, the sovereign debt crisis raging across Europe is really a currency crisis. The rise and fall of currencies is driving the rise and fall of bonds, stocks, and virtually every other asset under the sun. Currencies are now more important to the average American investor than ever before. And that's not just because the currencies pose a risk to your portfolios, but also because they offer you huge investment opportunities as well.
Today, we'll hear about many of those very opportunities. And in just a moment, we'll talk to one of the few currency experts who defied conventional wisdom and warned about the euro collapse well before it began. From our studios in Jupiter, Florida, Weiss Money Network presents Money and Markets. And now, Jamie Holmes.
Hello, everyone. It is not often that moves in the currency market become front page news, but that is exactly what we've seen over the past month, with China revaluing the yuan and the euro continuing its decline. Is this the beginning of the end for the European currency? And is China's move a significant concession to U.S. demands, or is it just lip service? Joining us with his thoughts on both these stories and an outlook for the foreign exchange markets is Weiss Research currency expert Brian Rich. Hello, Brian.
Hi, Jim.
Brian, let's get it right out of the way first. China, what do you think the impact's going to be?
Well, we can't really talk about one story without talking about another. China's move last month will allow its currency to trade against a basket of currencies rather than just the dollar. One of the main reasons for that, in my opinion, was to diversify its risk away from a falling euro. And to understand that, you have to realize that European Union is China's largest trading partner. So a falling euro means less buying power for European consumers, which poses a major threat to Chinese exports. Of course, a falling euro also has meant a rising dollar. In short, China wants to peg the yuan to the dollar when the dollar is weak, but not when the dollar is strong.
Brian, most experts think that another reason for China's move is just to pacify U.S. lawmakers who say the yuan is grossly undervalued.
Right. Well, that was part of it. And it may stop the calls for trade sanctions coming out of Congress for a little while. But in reality, we may find the move has very little effect on the value of the yuan against the dollar. China says it thinks its dollar exchange rate is already near equilibrium. And this latest move doesn't necessarily push up the yuan's value. It just lets it move a bit more freely in either direction. In fact, if you want to look at what traders expect the currency to do over the next year, they're pricing in less than a 2% appreciation against the dollar. That compares to an annual average rise of about 6% over the past 5 years, and that was since China first unpegged the yuan to the dollar. And I think the yuan could even go lower against the dollar, as opposed to higher. If China's economy turns down, the government could very well devalue its currency under this new, more flexible exchange rate policy. Because make no mistake, China is still very much in control of its currency here.
Brian, we're going to be talking to Tony Sagami and Larry Edelson later in the show. They both think the yuan could appreciate by up to 40% against the dollar over the coming years. You disagree. Mm-hmm. Why?
Well, they think that the global economy could fall into a double-dip recession. And I agree that's a possibility, certainly. If that happens, and if the sovereign debt crisis migrates to the United States, I think global investors will still view the dollar as a safe haven, a currency they want to own during a time of crisis.
Okay, you think the yuan will stay relatively low against the dollar. Well, let's talk the euro now. Is that decline going to continue?
Yeah, I think the sovereign debt crisis will continue to play out across Europe. One reason for the Eurozone's $1 trillion stabilization package is to bail out European banks because they're so heavily exposed to the debt of Greece and Portugal and other struggling countries. In the sense of desperation in this plan tells me that a euro devaluation is already underway. Debt crises tend to lead to currency crises, and that's exactly what we're seeing in Europe with the euro. But it's not just a sovereign debt crisis that's leading to the drop of the euro. That currency was structurally flawed from the very beginning. Europe's monetary union consists of a common currency and a common monetary policy. But fiscal policy is determined by each individual country, and therein lies the problem for the euro. From the outset, the European Union established 2 criteria to patrol fiscal responsibility of member countries. 1, deficit spending cannot exceed 3% of GDP. And 2, total government debt cannot exceed 60% of GDP. But as the financial crisis and global recession have shown, some member nations have completely ignored those rules. And perhaps more importantly, the rule book has proven to be unenforceable. The PIGS nations, Portugal, Italy, Ireland, Greece, and Spain, are the worst offenders, as you can see from this chart. But even some of Europe's traditional economic powerhouses, such as France, have found themselves on the wrong side of these guidelines. To understand why that happened, you don't have to look any further than Milton Friedman, one of the most influential economists of the 20th century. He warned that the euro would face these problems even before it was created. Friedman foresaw that a fiscal policy forced to adhere to rigid EU rules wouldn't allow member countries to solve their specific problems, such as using deficit spending and public works projects. He was right. More than half of the 16 countries in the monetary union are now running excessive deficits, completely ignoring the EU Stability and Growth Pact. Friedman also warned about emerging nationalism. He predicted that healthier countries wouldn't want to spend money to bail out their less responsible neighbors. When the sovereign debt crisis first hit Europe, Germany at first rejected the notion of big spending for a bailout of Greece and other troubled countries. But after Germany realized the problems in those nations threatened the European banking system, it had no choice but to go all in to prevent a collapse of a euro member country. Friedman even warned about what would happen during an economic downturn. He knew that exchange rates are valuable tools in a time of crisis, and that a common currency might handcuff individual nations. Italy is a perfect example of this. It has a history of devaluing the lira during bad times. But now, in a euro regime, it's unable to revalue its debt and improve its economic competitiveness.